Today we're answering the question at hand. What does MF mean in private equity? Now by the end of the video, you'll understand not just what management fees mean in private equity, but why they matter to every investment decision made in this industry. Management fees are at the heart of how some of the world's largest financial empires are built. These fees have created more wealth than most people realize, yet they're often the most misunderstood part of private equity. By the end of the video, I'll teach you and show you so that you can understand not just what management fees mean, but why they matter to every investment decision made in private equity. But first, let's start with a simple truth. Running a private equity firm isn't cheap. Think about buying a company worth billions of dollars. You can't just walk in with a checkbook and hope for the best. You need teams of experts for sophisticated technologies, global networks even. This is where management fees come in. They're the fuel that keeps this massive engine running. Now, the standard management fee in private equity is 2%. That might sound tiny, but let me show you why this small percentage changes everything. So let's say a private equity firm manages, $1 billion. That 2% means that they're earning $20 million every year just from management fees alone. And some firms manage way more than that. Imagine a firm managing, $10 billion. Well, that's $200 million in fees annually. It's pretty big, right? But here's what makes it really interesting. These fees aren't just profit that goes into somebody's pocket. They're more like the electricity that keeps the lights on in a factory. These fees pay for the armies of analysts who spend months, sometimes years, finding the perfect companies to buy. They fund the operational experts who know how to turn struggling businesses into market leaders. They cover the cutting-edge technology needed to analyze mountains of data and spot the opportunities that others have missed. Without these fees, private equity firms couldn't do what they do best. They wouldn't be able to buy companies and make them better. Think of management fees like foundation of a skyscraper. You might not see it, but without it, nothing would stand, right? In private equity, the fee structures create a stable ground that allows firms to take bold moves in unstable markets. When everyone else is panicking during market downturns, private equity firms can stay calm and look for opportunities, all because they have a steady stream of management fees keeping their operations running. There's also something fascinating about how these fees work over time. For instance, private equity funds typically last 10 years, but the fee structure changes as the fund ages. During the first 5 years, what we call the investment period, firms charge fees on all the money investors have committed, whether it's been invested or it hasn't. This makes sense because they're actively hunting for deals, searching for companies with untapped potential and conducting deep analysis. They need all hands on deck. But after those first 5 years, something changes. As the fund enters what's called the harvesting period, the fee structure often shifts. Instead of charging fees on all committed capital, firms now typically charge only on capital invested, money that's actually been put to work in companies. This creates a powerful incentive for firms to invest wisely and manage their portfolios effectively. Management fees affect every decision a private equity firm makes. When they're considering whether to buy a company, they're not just thinking about potential profits. They're calculating whether their fee structure will allow them to dictate and dedicate enough resources to improve that company. They're planning years ahead, considering how many experts they'll need, what technology they might require, and how to keep their best talent engaged for the long haul. Speaking of talent, a secret that often goes unnoticed with management fees is that it allows private equity firms to attract the brightest minds in finance. While other investment firms might offer bigger bonuses in good years, private equity can offer something more valuable, stability. The steady income from management fees allows them to hire the best and keep them focused on long-term success, not just quick wins, one and done as we call it in the business. Think about it, if you knew your salary was guaranteed for the next 10 years, you could make better long-term decisions. You wouldn't have to chase quick profits or worry about next month's paycheck. That's exactly what management fees do for private equity firms. Another really cool thing about these management fees is that they're like an insurance policy during tough times. When the economy gets rocky and most investors are panicking, private equity firms can stay calm. Their management fees provide a steady foundation that lets them stay patient and opportunistic. The stability, it's priceless during turbulent times. It's what allows firms to pounce on opportunities when others are forced to retreat. During these challenging periods, while other investors might be forced to sell at the worst possible time, private equity firms can actually increase their deal activity. The management fees keep the lights on and the talent in place, ready to act when valuations become attractive. Over time, these fees have changed in interesting ways. Back in the 80s, for example, when private equity was just getting started, firms often charged 3% or more. As more firms entered the business and got funds bigger, fees started coming down. It's like any other business, competition tends to drive prices down over time. Today, many larger firms offer discounts as their funds get bigger. They might charge 2% on the first $1 billion and then 1.75% on the next, and even less after that. It makes sense. After all, managing 10 billion isn't 10 times harder than managing 1 billion, so firms can afford to charge less as they grow. Dynamic, if you will, creates an intricate dance between private equity firms and their investors. Firms need to charge enough to attract and retain top talent, kind of people who can spot billion-dollar opportunities and successfully transform companies. But they also need to keep fees reasonable enough that investors can see attractive returns after these fees are paid. Think about it this way. If a fund aims to generate a 20% return, it needs to earn back both the management fees and enough additional profit to hit that target, right? This pushes firms to focus intensely on creating real value in their portfolio companies. They can't just make decent investments. They need to find and execute deals that generate exceptional returns. Looking ahead, we're seeing some interesting changes in how these fees work. Some firms are experimenting with new approaches, like linking fees to how well they perform or how they impact things like job creation or environmental goals. It's like the industry is evolving to meet new challenges and expectations. Technology is also having a huge impact. Modern private equity firms are using sophisticated computer systems and data analysis tools to find and evaluate deals. These investments require significant upfront capital that comes from the management fee structure. Something else that adds a layer of complexity to management fees is the global nature of today's private equity. For instance, running offices across multiple continents, dealing with different regulatory environments, and managing cross-border deals, all of this requires substantial resources. Management fees need to support this global infrastructure while remaining competitive in an increasingly crowded marketplace. Looking toward the future, management fees are likely to continue evolving. The rise of specialized funds focusing on specific industries or regions might lead to new fee models. The growing importance of environmental, social, and governance factors could influence how fees are structured. Some firms are already experimenting with linking fees to non-financial metrics like carbon reduction or job creation. But perhaps the most exciting development is how management fees are enabling innovation in private equity. Firms can invest in new investment strategies, develop proprietary technology, and build specialized expertise, all because they have the stable foundation of a management fee. Now, bringing it all together, we now know that management fees aren't just a cost of doing business, they're the foundation that makes sophisticated private equity investing possible. They provide the stability needed for long-term thinking, the resources required for thorough analysis, and the ability to maintain world-class investment opportunities. Understanding these fees helps us understand why private equity firms can do what they do. They can buy companies, improve them over 10 years, and create lasting value, all because they have the stable foundation that these fees provide. It's a perfect example of how structure influences strategy in the investment world. So next time you hear about management fees in private equity, you'll know they represent much more than just the straight up fee, right? They represent the engine that powers some of the most sophisticated investment operations in the world, the foundation that enables long-term value creation, and the structure that allows private equity firms to think and act differently from other investors. Well, thanks for diving into this topic with me today. If you found it helpful, don't forget to like and subscribe for more straightforward explanations of complex financial topics. Drop a comment below if there are other financial terms you'd like me to break down for you, and I'll see you in the next video, which you can access right here.